But I'm dazzled by this single best chart. We got to get back to the Bloomberg with Praveen Korapaty of Credit Suisse. How about a nostalgic look back to 10 years ago? Right here, folks, is the Tom Keene Employment Act of 2007. This is LIBOR-OIS, which is a measurement of confidence in the short-term market. Up we go. The financial crisis, Lehman Brothers, the world's coming to an end. Only Credit Suisse survived. And then we come down to wonderful quiet. And Praveen, there's this rollover right now. Why are we rolling over? What is the level of confidence of these strange indicators?
Yeah, so no, it's a great question. But I guess before we talk about why we're rolling over, it's interesting to see why we went up, right, more recently. And unlike in the crisis, the rise we saw last year was completely related to regulations, right? This was related to money market reform, created a shortages. Yeah. That's right. Last October, that was the peak. But what's happened since then is the fears people had about how much of a shortage there would be have been allayed somewhat. You've seen dollars come in from other sources to do some of the lending. You've seen borrowers shift their strategies, right? People who were borrowing 3 months have now adopted a barbell strategy. They're borrowing very short term or have termed out, and so that sort of compressed that spread.
Here's a pro question, and this goes to a lot of pros that don't understand your math world. Bring up the chart again. Back here, the world would stop on Bloomberg Surveillance on radio, and I would quote LIBOR-OIS here like it was religion and gospel. It's not anymore, is it? Why is that?
It's not. The banking system is a lot safer. What you had then was really LIBOR-OIS reflecting credit risk, right? That's not what's happening now. Banks are much better capitalized. The movements you're seeing now are related more to regulatory changes and the shifting strategies that various banks are employing in terms of borrowing. So it's not really an indicator of credit stress the way it was. Now, I will say, if you went back to 2011 and 2012, you did see a bit of a spike there as well in LIBOR-OIS. That was some sort of a stress indicator. You had the euro crisis then. And so it still functions that way. But the move we've seen last year and this year is not related to credit stress.